All right, Roundtable Trading Tuesdays. And yesterday, Monday's session, there was a very intense period where I was describing what went on in the pit, how the bar was actually created in the pit, and how emotions played into trading. Now, when I say pit, what I'm talking about is the old style person-to-person trading where literally you'd have like this open area with hundreds or even thousands of guys screaming at each other to execute trades. So one guy might be yelling buy, another guy might be yelling sell, and so they in turn match up with each other in order to make the trade. You really need to watch as any documentary. One of them is called Floored, F-L-O-O-R-E-D. Another one is called The Pit. These are documentaries where you can, and I do have to apologize, there's a lot of foul language in these, but that's just how a lot of traders are. So just keep that in mind. If you're really bothered by that kind of stuff, you might want to skip it, or at the very least, fast forward through the documentary until you get to the actual trading sequences, because you're getting how the emotion is created, Floored and The Pit. Now, in electronic trading, of course, it's all traded on computers, but that same kind of commitment and ferocity is how professional traders approach getting into and getting out of a position. So the reason why we want to anticipate the sneak attack, meaning the big bars pushing past a prior support level, or the big bars pushing past a resistance level, has to do with the emotion that's necessary to get a position put on and to push someone else out of their trading position. Now, with the Canadian dollar here, we started talking about the Canadian back here in June. We were first started off looking for some buys. We saw that price was breaking down and continuing to retest support like this. So price would break down and retest support and continue moving down. So we flipped around to looking for a sell right about in here. We then transitioned into looking for a buy once price came out of this support area. So right around here we were looking for buys. Here we were looking for buys. And then I stopped talking about the currency pair because nothing started happening. And here's why. Let's go up to, let me pause, we'll go up to a daily bar. One of the most important concepts that you can use in your own trading is the idea of proper trade timing. Proper trade timing comes purely from selecting what I call the controlling high and the controlling low. Now, I got that from one of my trading mentors because there is a low and a high that, so to speak, controls the market. In other words, where are the dominant buyers and where are the dominant sellers? So we have the dominant sellers up here. This is around 400. We have the dominant sellers around 120. The next dominant sellers are all the way back here around 9,800. So there's no reason to start looking for buyers until we get back down towards the dominant buyers. Look, the mistake that all of you are making in your trading when you're selecting bad trades is you're trying to trade when there's nothing to do. And it stems from this idea that we're working, right? That when we sit down to our trading desk, I'm, quote, working. And when we, talk to somebody, maybe it's a significant other or your spouse, and like, oh, hey, what happened today? Did you trade today? Or in other words, they're asking you, did you work today? The only proper answer is yes. Yes, I was trading today. And preferably don't go into details. Now, the reason for that isn't because you're trying to hide it from them, it's because they don't know what the hell they're talking about. Most people think that, if you're trading, then you trade every day. Now, that may be true in a professional environment where you're looking at, a bunch of different currency symbols and you have to trade. It's like you have to make something happen. They expect you to do something. In the retail environment, look, you don't have to trade every day. You need to wait for the dominant buyer. You need to wait for the dominant seller, or at the very least, something in between where you've got this is, I wouldn't call isn't the controlling sellers, but they're at least sellers, right? So when we start to trade in this area here, it's aggressive trading, and if we do too much of it, in other words, if price is staying in this no man's land, in between a high and a low, in between the controlling high and the controlling low, the longer it stays there, the more junky kind of trading we get, the more whipsaw trading we get. Those are simply put bad trades. So for the Canadian dollar, we got to take buys in this area here, which is really where price is at. So anyway, sorry to take 5 minutes on that, but that's really what I'm going to weave into all of the analysis that I give you in the next few minutes. So that's the background, that's the theory, that's the methodology. Now let's just run through this very, very quickly. This is the Canadian dollar on a 1 hour chart. I like buys in the zone from 136 down to 128. Yes, I like the lower zone. What does that mean? I want to see price come down into this area. I want to see a close outside of the area, and then I want to see a retest. I want to see all of that before I'm going to trade. Look, if you're getting stopped out, it's simply because you're jumping the gun. If you are trying to get in on this type of trading, you need to get over it. Your trade is not until this price or this price, this price or this price. You've got to wait because you are not the one that's making price. You are reacting to price. Let's take a look at the pound. The pound has been bouncing off of long-term support. It's been moving up off of that support, but then we've also got this little compression slash down trend line. I'm not looking to buy until price gets, yep, you guessed it, back into this buying area, or until price can break above resistance and then retest. Yes, there might be a few days where you're sitting there doing nothing. And I got to tell you, you know what? That just bothers most traders. Most traders want to trade all the time. Most traders are looking for something where they can sell, buy, sell, buy, sell, buy, sell, buy, sell. Yeah, good luck with that. You're not going to do it as a retail trader. You're paying too much in the spread. You don't have access to fast enough execution. In other words, if you pardon my coarse language, you're screwed from the beginning. That's why you're losing all the time. You need to pick better trades. Wait until price gets down to controlling buyers or controlling sellers, one of the two. Aussie yen, we were looking at this. We made a very successful day trade. Getting on the, where in the heck that was, let me pause. All right, that was all the way back on July 2nd. So we were, yep, that's right, back over in this area here. We took the trade into about the 82 level, and now it's coming back down. We've had several moves down here that have been met with buying. This one is back on my radar for a possible long trade, just to give you a heads up there. Now the euro. Of course, there's much ado being made of the euro being at blah, 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 multi-year lows. And yes, it is. What that means for us as traders is there isn't really a controlling low. We're waiting for that. So we've got to be cautious if we're going to step into this market and buy. However, we do have controlling highs. So 2675 is really the last controlling high. However, we are going to run into some likely sellers if price gets back up to this 2300, 2375. So if price does get in there, aggressive trades are okay. In other words, day trades, looking for the market to come back down. So let's go to the hourly bars and check that out quickly. Here's what that looks like. Here's what that looks like on the hourly bar. Sorry, got my language confused there for a second. So here's the prior resistance. Here's the prior resistance on the hourly. Remember, it's because on the daily bars, way back in the past, we had some prior buyers there. You can see price comes up, pushes down, comes up, and pushes down. Our job as traders is to wait until the sweet spot time and then take the trade if we get it. So this is right around 4 o'clock in the morning Eastern time. That's well within the sweet spot. However, there wasn't really a trade there because there wasn't a setup there. We're waiting for a price to come back. Doesn't quite make it. Price moves down. You've got to wait several days. Here's the Sunday gap, Monday trading. Now here we go. Price moves into our area. Let's check the time. That's 3 a.m. Whoops. No, 8 p.m. So, Japanese session, Asian session, price moves up into our resistance zone. Let's see what happens over here. 7 a.m. New York time, 4 a.m. New York time. We have lots of action going on, so let's take a look at it. There's 2 a.m. London. Price moves into our resistance zone on the hourly bar. You see sellers come in. How do we know? Price closes down. Now, price continues to come up, but settles down again. So the question is, where do we sell? Well, you're selling anywhere in here with a stop above this prior high. Now, what would have happened is you would have got stopped out. So where do you come back in? 3-bar reversal, which means you sell once price breaks that low. You're selling right here. Stop goes above this high. Boom, there is your trade. If you took that trade and you're in, you are going to want to exit because you've got now this whole thing going on here.